Welcome to This Explainer. Today, we're popping the hood on the Nifty 200 index. Now, if you're keeping tabs on the markets, you've definitely seen this name flash across your screen. But what exactly is it? Well, we're going to break down its anatomy and figure out exactly what makes this financial engine purr. Here's our roadmap for the breakdown today. First, what actually is the Nifty 200? Second, the index building blocks. Third, calculating the index. Fourth, the sector weighting breakdown. And finally, rebalancing and governance. Let's get right into it. Section 1. What is the Nifty 200? So this official Nifty 200 indexogram does a brilliant job illustrating our subject today. The Nifty 200 is explicitly designed to reflect a very specific slice of the market, specifically large and mid-market capitalization companies. It skips the tiny microcaps, and it doesn't just isolate the massive, untouchable giants either. It's actually a really strategic blend of the two. Basically, in the simplest terms possible, if you want a snapshot of how the established giants and the up-and-coming middleweights of the market are performing together, this is your gauge. It takes the stability of the large caps and bridges it right together with the high growth potential of the mid-caps, all into one unified metric. It's the best of both worlds. But how does the financial world actually put the Nifty 200 to work in real life? Well, portfolio managers use it heavily for benchmarking. They essentially use it as the ultimate measuring stick, right? To see if their own funds are actually outperforming the broader market. It's also the foundational architecture for launching index funds, creating exchange-traded funds, and designing those complex structured products. Basically, it's the bedrock for a massive amount of investable capital. Moving on to Section 2, the index building blocks. You might be wondering, where exactly do these 200 companies actually come from? The secret to the Nifty 200's eligibility criteria is literally just straightforward visual math. It is the direct combination of all the companies forming the Nifty 100, which, remember, represents the large cap segment, and the Nifty Midcap 100 indices. You just merge those two pre-existing indices together, and boom, you get the Nifty 200. This means if there's any change, like an inclusion or exclusion in either of those two smaller indices, it's automatically carried out and reflected in the Nifty 200. They are perfectly synced. All right, Section 3, calculating the index. So we know exactly what companies are in the engine, but what's the fuel powering it? The Nifty 200 index is computed using what's called the free float market capitalization method. Instead of just looking at raw overall stock prices, it weighs companies based only on the proportion of shares that are actually out there in the wild, the ones actually available for public trading. This is absolutely crucial because it gives us a highly accurate picture of true liquidity and real market value. Now, to ground all this abstract math into some foundational data, the index had to start somewhere, right? So when the calculations were first initialized, the index was assigned a starting base value of exactly 1,000. And that base value of 1,000 was locked in against a base date of January 1st, 2004. Think of this as the absolute starting line for measuring its performance over time. Now, the index itself was officially launched in 2011, but this 2004 base date, that's the anchor point. Every single point of growth or contraction that you see in the index today is ultimately just a mathematical reflection all the way back to that initial value of 1,000 set on New Year's Day back in 2004. Let's look at Section 4, sector weighting breakdown. When you apply all that math to these 200 companies, which sectors truly dominate this index? Notice the incredibly heavy concentration here. Financial services sits right at the very top, commanding a massive 33.12% of the entire index weight. I mean, it heavily outpaces the next biggest slices, like oil and gas at roughly 7.8%, or auto components at 6.8%. Essentially, if you're tracking the Nifty 200, you are inherently keeping a very close eye on the financial sector. Let's make those abstract sectors feel a bit more tangible. Look at the top heavyweights pulling this index along. Out of 200 companies, just 2 banks hold an unbelievable amount of influence. HDFC Bank alone commands a 7.31% individual weightage, and ICICI Bank follows super closely at 5.89%. Together, just these two institutions make up over 13% of the entire index's movement. It's wild, but it perfectly illustrates how that free float market capitalization method we talked about really elevates the absolute titans of the market. Finally, let's wrap up with Section 5, rebalancing and governance. Look, an index is really only as reliable as the rules that govern it. The Nifty 200 doesn't just sit there static. It's a living, breathing metric. It gets systematically rebalanced on a semi-annual basis, right in conjunction with the Nifty 100 and Nifty Midcap 100. The crucial cutoff dates for evaluating all that data are January 31st and July 31st of each year. And to ensure absolute market stability and transparency, they give a strict 4-week prior notice to the market before any of those changes are actually implemented. No surprises here. So, who's actually turning the wrenches during this rebalancing? Well, this rigid process is overseen by a highly professional 3-tier governance structure designed to maintain some seriously robust oversight. It starts way at the top with the board of directors of NSE Indices Limited, then it goes to the Index Advisory Committee for Equity, and finally the Index Maintenance Subcommittee. This whole multi-layered approach ensures that the index remains a pristine, objective reflection of the market. It is completely insulated from any arbitrary changes. So the crucial point I want to leave you with is this. You've now seen the engine completely taken apart. You understand how the Nifty 100 and Nifty Midcap 100 merge. You know how the free float methodology dictates power, why financial services completely dominate the landscape, and the strict rules governing its evolution. Now that you understand the true anatomy of the Nifty 200, how will you use this incredibly powerful benchmark to navigate your own market strategies? Think about it. Thanks for joining me for this explainer, and keep learning.